Okay, so I need you to stop scrolling for just a second, because what happened this weekend is the kind of thing that doesn't show up in your morning news digest, but it absolutely moves markets on Monday morning. We're talking a US military jet down, silver sitting at levels nobody predicted this fast, and a cocktail of geopolitical noise that, historically, has one very specific effect on Monday opens. So let's just walk through this together, calmly, clearly, because there's a lot of noise out there, and I want to cut through it. Let's start with the jet story, because this is the one that caught most people off guard. A US naval aircraft going down, regardless of the circumstances, triggers a very specific psychological response in financial markets. It's not even always about the event itself. It's about what traders imagine the event could escalate into. Markets don't trade on facts alone. They trade on fear, on uncertainty, on the possibility that something bigger is coming. And right now, with the geopolitical backdrop already stretched, tensions in the Middle East, ongoing pressure in the South China Sea, the Ukraine situation still unresolved, any military incident from the US side gets amplified. Not because traders are warmongers, but because uncertainty is the one thing markets genuinely cannot price in properly. And when they can't price it in, they sell first and ask questions later. Now here's where it gets really interesting. Silver. Let's talk about silver, because 73 is not a number I, or honestly most analysts, had circled for this point in the year. Gold has been on everyone's radar, right? Gold breaking records has been the headline. But silver quietly, almost sneakily, has been making its own move. And under 73 silver is significant for a few reasons. First, it tells you that the gold-silver ratio is compressing, which historically happens when industrial demand and safe haven demand are both rising at the same time. That's unusual. Normally you get one or the other. Safe haven demand pushes gold. Industrial demand pushes silver. When both are pushing silver simultaneously, it usually means the market is pricing in something, either a supply shock or a broader macro fear, or both. And when you layer that silver move on top of a weekend military incident, you get what traders call a risk-off cocktail. Everything that feels safe, precious metals, bonds, the yen, the Swiss franc, gets bought. Everything that feels exposed, equities, emerging market currencies, high beta tech stocks, gets sold. That's the setup going into Monday. Not a guarantee, not a certainty, but a very real probability that the open is going to be ugly for equity bulls. Now, I want to be fair here, because I think a lot of finance content online just screams crash incoming without giving you the other side. So let me give you the counterargument. Markets have shown remarkable resilience over the past 18 months. Every time there's been a geopolitical shock, and there have been several, dip buyers have shown up. Institutional money has used these moments to accumulate, not panic. The Fed's posture, while not explicitly dovish, has created a floor under risk assets that's been hard to break through. So it's entirely possible that Monday opens red, we get some volatility in the first hour, and then it stabilizes. That has happened more times than the Black Monday scenario over the past few years. But, and this is the but that matters, the difference between those previous dips and what we're looking at now is the combination of factors. It's not just one thing. It's silver at 73, which tells you inflation expectations are still elevated. It's a military incident, which adds geopolitical risk premium. It's a Friday close that was already nervous, with volumes thinning out heading into the weekend. When you stack those three things together, the probability of a violent open goes up meaningfully. Not to a certainty, but to something you should absolutely have a plan for. So what should you actually do with this information? And I always try to make this part practical, because I don't want this channel to just be fear content. I want it to be useful. First thing, if you have positions you've been meaning to trim, the time to think about that was before the weekend. But if you haven't, Monday pre-market is going to give you a lot of information in the first 15 to 20 minutes. Watch the futures before the open. If ES, that's S&P futures, is down more than 5% at the open, that's a signal worth respecting. That's not a normal dip. That's the market telling you it's genuinely repricing risk. Second thing, watch silver and gold together Monday morning. If silver is holding above the 72 and gold is pushing higher, that's confirmation that the safe haven trade is real and it has legs. If you see silver start to fade while gold holds, that's a more nuanced signal. It might mean the industrial demand component is softening and the move was partly speculative. That distinction matters. Third, and I say this every time there's a potential volatility event, cash is a position. There is nothing wrong with sitting in cash for a day or two while the picture clarifies. The people who lose the most in volatile opens are the ones who feel like they have to do something. Sometimes the best trade is no trade until the dust settles. Now let me zoom out for a second, because I think there's a bigger story underneath all of this that we should at least acknowledge. What we're seeing with silver, with gold, with the general nervousness in markets, this isn't random. This is the market slowly, reluctantly, beginning to price in a world where geopolitical risk is a permanent feature rather than an occasional disruption. For most of the post-2008 era, geopolitical events were blips. Markets recovered fast because the underlying assumption was that the world was basically stable, globalization was intact, and central banks had the tools to smooth over any rough patches. That assumption is under serious pressure right now. And silver at 73 is, in some ways, a reflection of that. People are buying real assets because they're not sure paper promises, whether that's currency or bonds or even equities, are going to hold their value the way they used to. That's a big shift. And if you're thinking about your portfolio over a 12 to 24 month horizon, not just Monday morning, that shift deserves serious attention. All right, let me bring this home. Here's the honest summary. We have a legitimate setup for a rough Monday open. The US jet incident adds geopolitical uncertainty. Silver at 73 confirms that inflation and safe haven demand are both elevated simultaneously, which is a warning sign. The Friday close was already fragile. Put those together, and violent Monday open is a real possibility, not a certainty, but something to prepare for, not ignore. What I'd encourage you to do is watch the pre-market carefully, have a plan before the bell rings, and don't let Monday morning emotion drive decisions you'll regret by Wednesday. Markets reward preparation and punish panic. That's been true in every cycle, and it'll be true in this one. If you found this useful, hit the like button. It genuinely helps this channel reach people who are trying to make sense of what's happening. And if you want me to do a deeper breakdown on the silver trade specifically, or on how military events have historically affected markets, let me know in the comments. I read them, I take the suggestions seriously, and some of the best videos on this channel have come directly from what you all ask for. Stay sharp, stay prepared, and I'll see you in the next one.